Hello, stock markets are like the weather. The complex meteorological factors that dictate how much sun, rain and wind we get are comparable to the many economic factors affecting our national and personal finances. For example, after a summer heat wave, you often get short, violent storms. These can be scary, but afterwards we usually feel they've helped clear the air so cooler, more pleasurable conditions can return. That's what experts are forecasting could occur in stock markets this autumn. In the past 5 years, since the financial crisis, stock markets have enjoyed a heat wave. Shares and bonds have basked in the sun as central banks like the US Federal Reserve in Washington have pumped trillions of dollars into the US and global economies under quantitative easing or money printing. Recently, the Fed, the largest central bank, has reduced this flow of easy money. By October or November, it's expected to stop altogether. This could unsettle markets that have got used to rising on hot air. Although markets have cooled since the Fed started to taper these financial injections, markets remain high, and the fear is we could get a repeat of last year when the Fed upset investors by revealing its plans. Right now, experts worry about an eerie calm that has settled on markets, the kind of calm that precedes a big storm. Levels of volatility, which show how much share prices jump up and down, have been unusually low, and confidence measures show investors are not afraid despite the tensions in Ukraine and Gaza. The concern is many investors are not looking ahead to see the big weather event coming next. The Fed stopping its money printing is a precursor to a huge cold front of rising interest rates expected to hit the UK as early as the end of this year and the US next year. Historically low interest rates are another reason why stock markets have enjoyed a long sunny spell. Interest rates have been stuck near zero in the UK and US for 5 years and are expected to rise very slowly to avoid crushing the economic recovery. Even so, that may not be enough to avoid bursting a bit of the bubble around bonds in particular, but also other assets like property and shares that pay a good income to investors. Their yields will look less attractive and their prices could fall. Gloomy forecasters point to 1994 when a sudden rise in US interest rates sent bond markets crashing, causing share prices to fall, although both later recovered. Optimistic pundits point to the fact that interest rates rising is a good sign, not a threat, because it shows the UK and US economies are recovering. This is broadly good news for share prices, although the outlook for bonds will remain very cloudy. What should you do? Many experienced investors have sold some of their holdings, particularly in bonds, and parked the money in cash, waiting for markets to fall to more attractive levels when they will reinvest. Turning to the long-term outlook, assuming the autumn storms pass and markets recover, investors can look forward to a bright outlook for shares, particularly in the US where economic prospects are best, although currently shares are expensive. It's a similar picture in the UK, although if the pound continues to be strong against other currencies, it will hurt company profits and hold back the FTSE 100. Europe's economy remains under a cloud, but could do well if the US leads a global recovery. However, there are questions over whether Japan's recent recovery is losing momentum. Don't forget emerging markets, which have had a tough time, but look better value now and could also benefit from a US-led recovery. The big cloud here is China, and whether it can avoid a financial crash after years of rapid growth. So, that's it. Markets need a breather, and an autumn correction may be what's required.